Hi, everybody. Welcome back. This is the second segment in our international trade module here. We're going to pick up right where we left off in considering case one, which is the case where a country is going to wind up exporting a good or service. And without loss of generality here, we're going to consider specifically the market for soybeans, since this is a relevant market in terms of current events in the United States. The U.S. is a big exporter in soybeans, and this is a major tension in the current trade dispute that we are facing with China. So we're going to first look at what the market would look like if we do not trade with another market in the international community. So without trade and autarky, the market gets pushed towards its equilibrium, its autarkic equilibrium. And in the equilibrium, the price of soybeans is $4 per bushel, and we are selling 500 million bushels in the market equilibrium. Okay, now remember, if we're in case one, a country that is going to wind up exporting soybeans, then what we need to do is remember that in this case, this is the scenario where the price in the rest of the world is actually higher than the price domestically. Now, recall from the last video that PW, when we open up to free trade, is the only relevant price. Okay, the rest of the world's price is up to $6. So any seller that has the option to either sell it domestically at $4 or sell it in the world market for $6 would only choose to accept the price of $6. It wouldn't be rational for a seller to accept $4 when they could go to the international community, to the world price, and get the sale done for $6. Meaning no seller would ever accept a price lower than $6, such that then, as a result, no buyer should ever expect to pay a price lower than $6. Okay, so all the trades are going to be made here at $6. Now, when we open up to free trade at this price, you'll notice right away that the quantity demanded and the quantity supplied are not the same. Okay, normally in the context of our competitive market model, this would cause a surplus of inventory, and we would observe downward pressure on that price from 6 down towards 4. However, in this model, there is not a surplus that builds up. Domestic consumers buy 300, the sellers buy 750. The difference between those, rather than being a surplus of inventory now, gets sold in the international market and defines the size of the exports. Okay, so all the sales are being made at the world price. Sellers will never accept a price any lower than 6, and as a result, buyers will never see any seller offering a price lower than $6 as well. So the buyers know they have to pay 6, the sellers know they're going to get 6. Okay, now what we want to be able to show here is that when we open up to trade in this export situation, that the total surplus has increased. Okay, that market efficiency has increased from opening up to free trade. Okay, so I'm going to go ahead and label these areas, and we're going to do our basic welfare accounting. We're going to look at the size of the economic pie without free trade when we're in autarky, and then we will compare that to the size of the economic pie under free trade when we open up and start trading with the international community. Okay, so without trade, when we're just in the domestic market equilibrium, the price gets pushed to $4, and our consumer surplus then would be, again, the area above that equilibrium price of 4, below the demand curve to the left of the quantity traded, which would be represented by the area AB. Okay, producers in the autarkic equilibrium, when we're not trading, they get surplus equal to the area below that price of $4, above the supply curve to the left of quantity traded, which is this area C. Okay, meaning without any trade, the total surplus looks very familiar. This is area A, B, C in total. Okay, now we're going to compare this outcome to the outcome when we open up to free trade at the world price of $6. Okay, note now that if the price increases to $6, okay, that the consumers are all paying a higher price domestically as a result of this. Okay, so now the area above 6 below the demand curve to the left of the quantity is a little bit smaller, and the consumer surplus is reduced from from A plus B down to only A. Okay, so we can see immediately here that consumers are actually worse off under free trade than they were when the economy was isolated away from free trade. However, if we were to measure the producer surplus under free trade, the producer surplus is the area below $6 above the supply curve to the left of the quantity that the sellers will supply. Okay, so the producer surplus is actually this entire triangle, BDC. Okay, so it looks like the producers kept their C and they added two chunks to it. They added B, which they captured from the consumers, and they've also added D, which was a chunk of surplus previously not acquired by anybody. So the total surplus in this situation has increased to ABCD, and we can specifically see here that the added value from the additional gains from trading in the international community is shown by this gain in surplus measured by triangle D. In the next video, we're going to consider case 2. We're going to do the same type of welfare analysis and show that the economic pie also increases when we wind up importing in a market as well when we open up to free trade. See you soon.